Hello Accounts 212 students. We are back looking at our groups. Today we're going to have a look at our chapter 3. Okay, as a reminder, we have already discussed chapter 1, which was the theory to determine whether we have control. And today we are going to have a look now, once we've determined we have control, how are we going to be doing the accounting? Here's a reminder of our lecture structure. We have 6 videos that we're going to have a look at, and we are currently having a look at video number 2. We're going to start looking at wholly owned, in other words, 100% owned companies, and we're going to be focusing only on the statement of financial position. So within this chapter, we're going to be having a look at what is consolidation and how consolidation works. And our focus is going to be on purchasing an entire company. Okay, so we're having a look at chapter 3 of our prescribed text. Okay, that's Notes on Group Financial Statements by Keith Prinsloo and Derek Forsyth. Okay, chapter 3 will focus on the wholly owned subsidiaries. We're going to be looking at the entire chapter. So please make sure when you are busy doing your recap and your studying that you do have a look at the entire chapter. Okay, we're going to be going through examples mainly, so there are not very many slides. These slides are available on Moodle for your pursuit. Okay, the 3 examples that we are initially going to have a look at is 3.1, 3.2, 3.3. And these 3 examples are indicating to you 3 different ways that we can acquire a company. Okay, so 3.1, we can acquire all the assets and liabilities of our subsidiary. So when we have a look at 3.1, we're going to notice that we will see that H, which is our holding company, went and bought the individual assets from S and took over the liabilities of S, and then later on S was liquidated. So in this form we have H, which has everything in it, all the assets and all the liabilities, and S has nothing in it, it's a shell company, and therefore it was closed down. Okay, 3.2 then illustrates with the same numbers what would happen if instead of purchasing all our assets and liabilities, we decided that we were going to purchase the shares of S instead. So we have 2 separate companies. We have H and S. However, H now owns the entire shareholding of S. So therefore, they control S. So that would mean we would need to do a consolidation. Okay, because we have control, we have that 100% of S's shares. And we're going to have a look at what that consolidation will look like. The last example on this page, example 3.3, has a look at if we want to form a new company to do, let's say, a new venture. So H is a developed company, and H would like to open a new division. They don't want that division to necessarily impact on how they are currently performing. So they open a new company to house that division in. And if that division then makes a loss, it's a separate company making the loss, and it doesn't impact H's profits. Yeah, so we'll have a look at that on page 39. Right, so here we are in our textbook. We're going to begin looking at the examples. We're going to start with example 3.1 through to 3.3. Right, so here we are in our textbook. We're going to begin looking at the examples. We're going to start with example 3.1 through to 3.3. Okay, so example 3.1 was where H acquired all the physical assets of S, as well as took over all the liabilities of S. So S became an empty company once there had been that acquisition, and then S became liquidated. Okay, so here is our statement of financial position of S. You can see we have some assets, and our assets were broken into non-current and current assets. Okay, so they could have some PPE, they could have some debtors, they could have some cash on hand, they could have some inventory. Okay, all that would be sitting under the assets section. We have our equity section. We can see they had 100,000 shares that were in issue. Okay, and that was their share capital, which equated to 120,000. They had 25,000 sitting in other reserves, and obviously S had been trading, and for all the years before they have made profits, so they have made and got some retained earnings equating to 75,000. Okay, and our liabilities, we then also have some non-current liabilities such as a long-term loan, and we also have current liabilities such as our trade payables. Okay, H also has some financial statements. We've got a statement of financial position for H, and we can see before they made any purchases of S, this is what their position looked like. They had 1.4 million worth of assets divided between our non-current and current assets. They have 1,050,000 rands worth of equity. They also had share capital, other reserves, and retained earnings. Okay, and then they had liabilities equal to 350,000. Okay, remember from your accounting knowledge, your assets are equal to your equity plus your liabilities. So on our statement of financial position, when we have an official statement of financial position, we would always see that our assets section is equal to our equity and liabilities section. Okay, so H has paid 300,000 Rand cash for S's net assets. In other words, they have taken over their assets as well as their liabilities, and for that they have paid 300,000. So when S's long-term loan payments need to be made, it is now H's responsibility to make those payments. They're no longer part of S because H has taken over that responsibility. When S's debtors need to pay, they will pay H, not S, because H has overtaken that asset. Okay, so in deciding how much it was willing to pay for these assets, H considered that S Limited's assets were fairly valued. So in other words, when we go back and have a look at S's statement of financial position, they said the non-current assets, yes, they are worth 240,000. Our current assets are worth 100,000. Our liabilities are worth 120,000. Okay, so that means that they are actually acquiring 220,000 rands worth of net assets, because they're getting 340,000 assets, but they are taking over 120,000 rands worth of liabilities. So our net assets is equal to our assets minus our liabilities, which that would equal to 220,000. Okay, but S is paying 300,000 for these net assets. Okay, so they are paying a premium, and when they're paying a premium, that would mean that they have paid in for some goodwill. Okay, so our journal entry that will happen in S's books is that we would have paid the 300,000. Okay, so we would be crediting bank. We would be acquiring some assets. Okay, we are acquiring assets of 240 non-current assets. We are acquiring assets with 100,000. Here we are taking over liabilities, non-current liabilities worth 90, current liabilities worth 30. Okay, so we can see our net here. There's our 340. Here is our 120. Our net is 220, but we are paying 300,000. That means we're paying a premium. So that balancing of the 80,000 will go into what's referred to as goodwill, which is us paying a premium for our net assets. Okay, so important. What is going to be happening once we've done this journal entry? If we go back up to S's books, S no longer has this 240. S no longer has this 100. Okay, but in this section here now, under our current assets, we will have received that 300,000. Okay, so although we no longer have these, okay, so that is no longer there. We have received 300,000 cash. So in our assets, we would be having 300,000. This is directly after the acquisition. The liabilities will also no longer exist because they have been taken over by our H Limited who bought it. In our equity, we now would have shown a profit on sale, and the profit on sale would have come through into our retained earnings. So we would have made a profit of 80,000. Okay, so that means that our retained earnings is actually going to be equal to 75,000 plus 80,000, which will equal to 155,000. Okay, so our statement will look as follows. We will have bank of 300. We will have a share capital of 120. We will have other reserves of 25. And we will have retained earnings of this 155 over here. Okay, so our financial statements would be balancing, because in total, that would mean that our total equity of over here would be 300,000. Okay, so instead of that 220, we would have 300,000. Okay, what will happen after that? Because we have bank of 300,000, we have equity of 300,000. S will then go and pay out their equity shareholders. Okay, the people, there's 100,000 shares, so everybody will get 3 Rand per share. And then we will have no bank. So that would have gone because we would have paid that out. And we will have no equity. Okay, so no share capital, no retained earnings, no other reserves. Because of the fact that we have paid out that 300,000 to our shareholders. So once we have paid that, we can see that we have absolutely nothing left in S's company. We have no assets, we have no equity, we have no liabilities. We have effectively liquidated this company. This company can now close. because we do not have anything left in the company. Okay, so let's move down and see. We've seen what's happened with S. Now let's go back and have a look what happens with H. Okay, we've had a look at our journal entry. Okay, so in H, our non-current assets, we are increasing. So we are adding 240,000. Our current assets, we are adding 100,000. Okay, as per our journal entry below. We then have goodwill. Goodwill is an asset. And it is increasing by 80,000. Okay, so that goodwill there is actually under our assets. Okay, there's just not enough space to put it in there. So it will come there below our assets. Goodwill is a non-current asset. Okay, so you could put it as part of this portion over here within the non-current assets as well. Okay, nothing has happened to our equity. In our current assets, we have spent some money, our 300,000. So we need to deduct that 300,000 that we have spent. We have acquired some more non-current liabilities. That was 90,000. So we're going to increase that by 90,000. And our current liabilities would have increased by 30,000. Okay, so this working over here that we've just put in, that just is part and parcel of this working, this journal entry that we would have processed. Okay, so if you process all those, then we will see what the position of H looks like at the end. Okay, so if we carry on through, we can see this is what H looks like. Okay, once we have processed that journal entry. Okay, so in our non-current assets, we have goodwill of 80,000. In our non-current assets, we have all our other non-current assets. That was 650 plus the 240 we got from S. Our current assets, we had 750. We spent 300,000 on S's net assets. We acquired 100 of S's currents. Okay, so there's our calculation. Our equity has remained unchanged because we did not do any equity transactions. Okay, our liabilities, we have acquired the extra 90 for non-currents and the extra 30 for currents. Okay, so we can see when we have a look at this financial statement, that is the position that H would be in. We will have no S and everything will be sitting in H. Okay, so that is the first way that you can acquire your company, is by purchasing all of its net assets. However, that's not necessarily advisable to do because now everything is sitting in one company. If something has to happen with S's assets or with S's liabilities, okay, it could bring H's position down. Okay, so for this reason, we would prefer to do example 3.2. Okay, where instead of us actually having one company that has everything in it. We have H that has H in it, and H then buys the shares for 300,000. So they own a share, they have an investment. So in their books, under the non-current assets, we would now see investment in S Limited. Okay, and our current assets will be down by that 300,000 because we would have purchased that investment. And then S would be sitting on its own, showing all its position. So now we would be in a position where we need to consolidate because we have a parent, which is H. They have a holding in S. It's 100% share. So they do have control of S. And we therefore need to perform a consolidation. Okay, so if we have a look, there's our statements of financial position of H and S. Exactly the same as what we had a look prior to us acquiring S. Okay, the difference now is we have acquired shares. So like I said, you can see under the non-current assets, we have this investment in S, the 300,000. Okay, and that 450 is the 750 minus the cash that we used to buy our shares in S. Okay, so because we've bought the shares, S still has all their assets. S still has all their liabilities. We haven't physically gone and taken them out of S so that S can pay out its shareholders. Instead, we have paid S's shareholders. So there was no transaction with S here. We paid S's shareholders the 300,000, and we now hold the shares. Okay, so this 300,000 will not affect S at all because the investment in subsidiary is the purchase of shares of those shareholders that already had the shares in S. Okay, so we would be doing a consolidation, and when we do a consolidation, what we are doing, because we own 100%, we are wanting to add the two together. Okay, so what we are saying here is we H own S. Okay, so therefore, let's show our position together. Okay, so that's what this consolidation column here is, showing our position together. The issue with just simply saying, well, let's go H plus S, is you'll see, for instance, share capital. If we go H plus S and we don't do any of these adjustments, which I'll discuss shortly, we're going to be telling our shareholders that their share capital is 620,000, when in fact it is not. Our shareholders, H's shareholders, only has share capital of 500,000. Okay, so we want to be able to show this to our users. Okay, we would also be saying to ourselves, well, we have an investment in subsidiary of 300,000. If we go 300,000, S does not have an investment in subsidiary, plus 0. And we say in our consolidation, we have an investment in subsidiary, then we are technically double counting. Okay, because what does this 300,000 represent? That 300,000 represents the fact that we have purchased the equity, okay, the shareholders of S. So that 120, that 25, and that 75,000 is represented by that 300,000 purchase. So therefore, these adjustments that we are making here, we refer to them as pro forma journal entries. They have to be done every single time we perform a consolidation. We would be saying, yes, we are H Limited. We are the holding company. We hold 100% of S Limited. So we want to add what they have to our position so we can show our position as a whole, what we control as H Limited. But this 300,000 represents their share capital, their other reserves, and their retained earnings, their equity, because it represents the net assets of S. We are paying 300,000 for 220,000 rands worth of net assets. So we have got a goodwill of 80,000. Yeah, we have overpaid. Why would we have paid for that? Okay, remember S is an operating business. So they have got customers already. They have got a standing, a market standing. So they've got some sort of name towards them. Obviously, this must be a good name that they have towards them because we are willing to pay more. Okay, so goodwill are those unseen assets per se that you can't actually physically recognize every single thing of. If you go back to your accounts 211 work, where you had a look at internally generated goodwill, okay, you should have learned that the goodwill that is internally generated may not be recognized in your statement of financial position. Reason being because we cannot reliably measure it. But as soon as somebody comes and physically pays for it, they've then put a measurement on it. So they've now said, yes, your company has 220,000, but I'm paying 300,000 for it. I'm putting a value on you. So now that is why we can recognize this goodwill of 80,000, because even though it is with regards to those internally generated things, we have now got a value for it because somebody has purchased us. Okay, so these adjustments, these debits and credits, like I said, that's the pro forma journal entry that would be processed. And this journal that we are seeing here is the journal to remove the investment of 300,000 out of H because it represents company S, which we have added in to our consolidation. It represents S's net assets, okay, which are its equity. So therefore, we're going to be removing the investment in subsidiary. We are going to be removing S's equity because when our shareholders have a look, we don't want to confuse them by saying we actually have 620,000 share capital when in fact we don't. We only have 500,000 share capital. And the balancing would be goodwill. Okay, we will learn when we have a look at chapter 4 as well that it doesn't always end up being goodwill. Yeah, so for this kind of transaction, we could have thought, well, S is showing us that they've got 220,000 net assets, but I'm only willing to pay 200,000 for it, be it because of a bad reputation or whatever has happened. That means we would have a negative goodwill, and negative goodwill goes into our income. Income will then fall into our retained earnings, okay, because our profits goes into our retained earnings. But we will have a look at that in chapter 4 again. Okay, so we can see our pro forma journal entry over here. Okay, and then we can see our final consolidated financial statements. Okay, and note, if you have a look at these figures and you have a look at the figures when we purchased the actual assets physically and took over the liabilities physically and closed off S, you can see that you're getting the same result. Okay, and that's why we perform these consolidations. Because ideally, we're not just going to go and purchase everything out of a company and add it to our current company. We would rather leave that company in its legal form so that it can operate accordingly, and then we would consolidate so that we can show our users, yes, we had that investment in S, but we technically own absolutely everything in that company. We can control what it does because we have 100,000, or because we have 100% of the holding. We can say exactly what happens in S. So what is the big picture for our shareholders is if S does well, H reaps from it. So we need to show our shareholders that result. Okay, example 3.3 just shows what you would then be doing if perhaps you had to form a company. Okay, so there's not a company that's doing what you want to do. So then H would then form a company. They would subscribe for the shares, the 400,000. So that means the cash would land up in S's books, the 400,000, and they would have share capital 400,000. The company S has just been formed. There hasn't been any trading at this point. So we have no assets and we have no liabilities. We have no retained earnings because we have not actually operated to get profits to be able to go into retained earnings. Okay, so when we are doing the consolidation here, what we're going to be saying is that this 400,000 is represented of this 400,000 in S. So we would perform our pro forma journal entry of removing our investments and then removing our share capital of S, and our consolidated financial statement would look as follows. We can see that our current assets are worth 750. Our share capital, etc., is still H's share capital. That's very important. Okay, so that equity portion is still just showing H. Yeah, and that's a very important thing to note, because when we start going into chapter 4 and we control, but we don't hold absolutely everything, we will still see equity of H here, but we are also going to see some non-controlling interest as well to show, well, we don't actually own all of that. Our investment is not worth all of our net assets in S. Okay, but we'll get through to that in chapter 4. Okay, what we need to note when we're having a look at when H purchases S, yes, our holding company is going to purchase the shares of S. When they do this purchase, they're going to be having a look at S's financial statements to see what the net asset value is. But they are also going to have a look at what the fair value of the items are. So for instance, if we have land and buildings, land generally appreciates, but in S's books, unless they use the revaluation model, they've probably recognized it at cost. So if they bought that land quite a while ago and they purchased it for 50,000, that same land might be worth 100,000 today. So we need to then do an adjustment for that fair value. Okay, also note, when we are having a look at consolidations, our carrying amounts of our property, plant, and equipment will become the cost to the group. Okay, and then there is deferred tax consequences with respect to the revaluations. However, for second year, we are not examining that. So you may ignore any deferred tax consequences with regards to these adjustments that we have just discussed. And we're going to look at example 3.4 on page 40 in order to go through that. Okay, example 3.4 is illustrating the fact that when we purchase, sometimes we don't agree with the valuation. Okay, so here we can see there's S's land and buildings was worth 60,000 in the financial statements. Obviously, it's measured at cost. Land has appreciated. We've had a look at the fair value and we've said, well, land is actually worth 110. Okay, so we would have taken that 110 into consideration, not the 60, when we determined our purchase price, which in this situation is 400,000. So when we are doing our consolidation, we will be indicating that this 60,000 is actually worth 110. So the extra that we are paying, which we can see here, the net assets are 320. The investment that we made was 400, so we paid 80,000 extra. Of that, one of the reasons we paid extra is actually because of this land and buildings. Okay, this 50,000 extra. So that means only 30,000 was with respect to the internally generated goodwill, which we have put a value on now, so we can recognize it as goodwill. Okay, so when we have a look at our pro forma journal entry, what you are going to see is that our land and buildings have been debited with 50 to get it up to that 110 mark. Our goodwill is therefore only 30 because we had purchased net assets worth of 320,000. Okay, the other note, which was on the slides, is for the group, our cost is the carrying amount on the date of acquisition. So because of that, we have this journal entry that we need to make. Okay, so if we are showing our cost and accumulated depreciation separately, like what is shown on our financial statements at the top there, we then need to make sure that we cancel out the accumulated depreciation to the cost so that we are only showing our carrying amount as cost. Okay, so there is our workings. You can see there's our adjustments, which are our pro forma journal entries, which have already been discussed. Okay, so you can have a look at those adjustments. This would be our consolidation column. Okay, that consolidation column over there. And that would be what we would be presenting as our consolidated financial statements. Okay, and those are the examples for chapter 3. Okay, the next chapter that we're going to be having a look at, chapter 4, now has a look at a more realistic scenario where we don't actually have all the shares. We don't have 100%, but we have quite a few shares and we have majority and we still have control. How would we be accounting for that? Again, we're still only looking at the statement of financial position at this point, and we're still only looking at on the acquisition date. So what do we do on acquisition dates?